All right, welcome to the Note Investor Podcast. I'm Dan Deppen, and today I'm joined by Nick D'Angelo. Nick, how you doing?
Dan, doing great. Great catching up with you a second ago here before the show, and looking forward to jumping in here.
No, sounds good. So, no, appreciate you coming on. So, maybe you just give us a quick, little bit about your background and how you got what some of your involvement in notes has been.
Sure. So my name's Nick D'Angelo. I'm CEO of Saint Investment Group. My earliest foray into the note space was actually because I was buying a lot of distressed assets on the courthouse steps. So I was the guy buying all your notes when you're going to foreclosure, right?
Mhm.
We did that primarily for commercial deals. We were underwriting, hundreds and hundreds a week. This was in the wake of the 2008 global financial crisis. We were buying at our peak about 10 million a week on the foreclosure, on the courthouse steps. So naturally, I'm sitting there at an auction one time and I'm like, every time I'm at this deal, I see this one guy and he's in the back. He's got a gold watch on and a yacht club hat pulled low. And the deal never seems to happen. It never goes with the crier. It's always delayed whenever I see this guy. So I walked up to him one day and, I'm sitting there with a whole bunch of sharks bidding at stuff on the steps. I got a bunch of, cashier's checks in my pocket. And I go, hey, who are you? Because every time you're here, my deal doesn't go through. And so he starts laughing. And I'm a young kid. I'm in my early 20s. And he starts laughing. And he goes, kid, there's a lot to this business you don't understand. And I said, great. Well, I got time. You just screwed my deal over possibly. So tell me about it a little bit. And he just said, look, I'm the note holder, right? So if I ever see you here, this deal's not happening. And this is the Wild West days when things were, he's doing baseball signals to the crier and things like that that are,
Mhm.
not, very frowned upon. But all that to be said, I dug in. I learned a lot about the note space. I realized that there's a much bigger pool of assets. There's layers to this. There's a much more widespread, strategic level to distressed assets, and I fell in love. So since then, we've ramped up quite a bit. We started taking on outside investors. We had a small pool of investors in the beginning, took on outside investors in 2015, and then started a fixed income fund, which leans primarily into notes. So that's where we're at today. We're just crossed 206 million in assets under management, and I still love the fixed income and note space more than ever, and especially debt with real estate is our focus.
Yeah. So what kind of notes are you buying these days in your fund? Is it more like residential versus commercial or performing versus non-performing?
So we like non-performing, I mean semi-performing or rolling balance, kind of middle of the road. We're not that um cute as it relates to really niche. We kind of like staying in the center.
Mhm.
I was laughing, or you and I were talking about before some of the big names that you've had on the show in the note space. Over the years, we found that as we worked our way up the ladder, as we, built our portfolio, that we were best at raising capital and acquisitions. And that the asset management side, there's so many good asset managers in the note world. So we've found that partnerships have been a really good thing for us and a really good thing to build the business, especially
Mhm.
with really strong asset managers over the years. So we've leaned into a lot of really good partnerships as one of our strategic growth points. And our partners consistently are the best partners we work with are niche down into what they like. Right now, what we're seeing as the major focus of our closest partners are owner occupied, middle class, cookie cutter, 3 bed, 2 bath type properties, you know,
Mhm.
um, suburban, right? Not overly urban downtown, not overly rural where you're dealing with kind of like local courts where everybody's a cousin or, close friends. We've all dealt with those cases, right?
Yeah, or there's like one vendor in town, and if they're terrible, you're hosed,
We all know that one, right? And you're looking for
Yeah.
broker price opinions, and it's like, well, I don't know, and you're like, oh, okay, I know this game. I know this
Yeah.
game. Okay, so we stick pretty middle of the road. Our the partners we've had, especially recently, they are buying bigger and bigger tranches, bigger and bigger pools, bigger and bigger tapes. So that's what we've leaned into. The most strategic point for us is to focus on capital raising and capital allocating and working with really good partners and asset managers.
Yeah, it's interesting you call it out like that because I hadn't really thought about it in those terms, but those are kind of different skill sets between raising capital, buying assets, and then actually working them out and running the day to day.
I mean, here's an example that you and every listener will know, right? There's so many skill sets in the note space. Again, my background was acquisitions. So I know deals. I know how to underwrite deals from a financial perspective. I understand the strategies and I know what fits for us. But have you ever seen the due diligence that certain people do where it's 20 layers deep and they are finding the most amazing details and you can fit that in with a broader strategy? Those are two different personalities a lot of times, right?
Hmm.
So the last thing we want to do is deprive our fund or our investment or one of the tapes that we're buying of the best skill sets to apply to that. So we've leaned into strategic partnerships very heavily. And as we've scaled, I mean, even on the hard asset side, right? You look at a lot of the bigger operators, some are fund managers and they're really good at that. Others are classic asset managers and acquisition people, and other people focus full time on capital raising. So on our side, we've tended to lean towards our strengths on that, work with really good asset managers, but their ability to sort through huge amounts of data takes a team of 25 people, right? So these
Yeah.
are not these are different skill sets at higher levels that we've really come to appreciate.
No, that makes sense. I'm curious, are you guys looking at any technology solutions to try to get through that stuff? It wasn't on a podcast, but just yesterday I was having a conversation with somebody where they kind of have that problem where they have to onboard and, handle lots of assets. And so they're starting to look at trying to build some fancy tools to get through title work and get through paperwork and get through servicing pay histories and stuff like that. Feels like that's where the industry is eventually going to go, although it's like nowhere near that today.
I mean, here's the two things I got my eye on tech wise. One is obviously AI, which ties in basically exactly, on the nose to what you're saying. The AI component of being able to digest these huge trends, these huge numbers, these huge tapes, right? I think there's a huge opportunity there. I just haven't seen a freaking model really be able to tackle it effectively yet. So it's like I'm sitting there, I want to see it too. I don't think that removes the human element. I'm going to be honest. I think that is a complementary tool in the human's toolbox. The second is, and we've been talking about this for years now, but it's the blockchain technology applied to title, right? So that we can get clear title. It would clear up a lot of the foreclosure headaches. It would clear up a lot of, I mean, the dark side is it might destroy the title insurance industry, but I don't see that either. I see that again as a component of that and as a complement to that industry. So those are the two I have my eye on. The obvious is going to be, a generative AI solution where AI is really learning from going through, thousands of assets at a time and digesting what those numbers are and what are our yield hurdles, what are our expectations, how to navigate risk on a true statistical basis, which
Hmm.
that's been elusive for the industry. It's been tough to nail a lot of this down. And even the highest level people that I know, the highest level asset managers, we could all sit around and debate risk of like which variables really lead to which things and which risk you prefer in the marketplace and what you're willing to trade. For us, we never really prefer foreclosure, so we're usually more averse to that. Whereas I got friends that can't wait for foreclosures; they'd rather turn the properties and get the properties back. So, generative AI and then that blockchain, that really true blockchain and title, I think I got an eye on big on the technology component.
Yeah, one of the big challenges with that is getting enough data to build the right model because there's so many variables to these things. It's just it's challenging to do. So
Yeah, no, not a lot of super open operators where everyone's sharing their spreadsheets either, right? Nobody's sharing their in-depth due diligence, which might
well,
speed it up. But
so one of the things I'm thinking about, I haven't done anything with this yet. I don't know if I told you, but this would be announced before this comes out. But I bought Call the Underwriter recently, right? And so they do underwriting for seller finance loans. So I've got this pretty healthy database of all the underwriting materials of all these seller finance loans that have been created over the last several years. So one of the things I'm thinking about doing is figuring out a way to easily look up all the records and say, okay, these that got created, how many actually was there a foreclosure action that happened? Was there like a Liz Pendens filed or something else? And then I've got all the other underwriting data, and I want to try to use that to to build a model to like understand the sensitivity of some of the different factors that went into it, like the down payment size, credit score, blah blah blah. Like there's like 100 of them that you could do. We'll see if I pull that off or not. I don't
No,
make
I
any
think you're the
promises,
guy
but
for it. If
it's
you have that
yeah.
amount of data and you have that platform, you are the exact guy that can plug in an AI solution to that and just digest the data and figure out, a solution based on a mountain, a trove of data. I think that's perfect positioning.
Yeah, I know how
I'm
they went
excited.
in.
Keep in
The trick,
touch, Dan, because I want to
no,
I
I
want to
will.
know where that goes. I'm into that.
Yeah, the tricky part. I mean, I know how they all started. The tricky part will be figuring out where they all landed. You know what I mean? That's like
Yeah,
where they all landed.
that's
Because I
true.
don't. Because it's not like I don't own the loans. So
Yeah. That's
yeah.
exciting. I think the industry needs it, right? I mean, the note space I've seen make huge leaps and bounds and huge strides and very sophisticated, especially financially. The hard asset side can lag behind, I'd argue, in real estate. So
Mhm.
if a good AI solution can step into the note space, I think that's really the perfect place, perfect time. So that's exciting.
Yeah, for sure. So shifting gears a tad. So it sounds like you're deploying, some cases hundreds of millions of dollars. I'm interested to get your take on where we are in the economic cycle and what you've been seeing. To me, it's been kind of a weird market. Like the economy was hot, then we had COVID, then I thought the world was going to end, then the market got hot, and then it's been, we've had this like inflation and it doesn't feel great, but it's not really bad. So I'm interested in how like what your view of the world is
Yeah,
from the
absolutely.
economics.
So where we sit today, we look at economics very heavily because we balance both sides. We have hard assets, and then we have the fixed income side, the debt side. So we're always trying to dig in and see where the economy is going, where specifically investments and real estate in general are going. What I see are kind of extremes, which is what you just described, right? On
Mhm.
one side, you have these great reports that keep coming out, right? We're beating expectations in many ways. We see many aspects that are heating up or, not quite overheated, but performing well. But then, consumer and investor sentiment is very low, right? So it creates, for instance, in the mortgage rate environment, it can create these bigger swings than would have normally been expected by just the data. So
Mhm.
I think, and what we see and the trends that we're tracking are that there's a few really big underlying drivers in the economy that are less understood. News has dumbed down over the years, right? We're just talking about, kind of really, really high, really, um, light diving into financial topics when you watch the news today. So people miss a lot of big things happening below the surface. What we're seeing, what we're tracking is a longer trend of inflation. And I don't say that because I love it. I say that because it's I think not that we will experience inflation at higher levels. I don't think we're going to hit 9.1 like we did mid 2022. That's
Mhm.
not what I see in the horizon, but upward pressure from inflation. So that might mean higher mortgage rates for the next decade plus. I do bet on that. I do believe we'll see 5.5 to 6% for mortgage rates for a decade plus. A lot of big names are seeing the same. I think it was like, Bill Ackman, the head of the National Association of Realtors, Howard Marks. Some of those guys might be betting against the grain a lot of times, but I happen to really believe that that's the case with a couple drivers like baby boomers exiting the workforce, Gen Z being much smaller generation, lower labor participation, a lot of labor inflation. I think we have a lot of changes happening in the economy where we're being, in a consumer driven economy, like where that's coming from and what those drivers look like. And then what I've been scratching my head on the most, just like everybody else lately in the short term, is what's going on with mortgage rates and why didn't we get the dip that we expected? And
Went
homeowners are sitting on the sidelines, right?
they went the other way, right? Like they lowered treasury rates and mortgage rates went up.
I mean, what a time, right? What a time.
And
And we could talk about there's part of that is, well, the expectation of, well, does the Feds keep lowering rates? They got aggressive. They did a 50 basis point cut, but things still are going pretty good, and things are humming along. Why would they continue to make cuts? So if that's the
mhm.
case, a lot of the discussion was that 50 basis point, that 0.5% rate cut was already baked into the investment world. It was already baked into Wall Street. It was already baked in to a lot of the calculations. So now we're sitting at really a balanced perspective, with the understanding that they might not be so aggressive on rate cuts moving forward if we are in a balanced economy. So that's one. I would say that the other thing we're looking at is national debts rising crazy. We all know that. I think that's a longer term concern. I'm concerned with the things happening on the Fed's balance sheets behind the closed curtain, if you will. Things like the interest that they pay to banks, which this year is $500 billion, $483 billion that they're paying interest on to reserves that banks are holding. So some of those trends, I think, are
Mhm.
causing bigger ripples and bigger waves downstream that most people aren't seeing.
Yeah, that makes sense. Yeah, to me, it seems like I remember the 90s and the pre-financial crisis times where we had these like boom times where everybody thought everything was perfect. And then people got way ahead of their skis, whether it was in real estate or the tech sector or whatever. And then you had these crashes. But it seems like the last several years, everybody's so scared to death of that. Like nobody gets ahead of themselves. So the economy never overcooks, but it's doing fine and it never comes back. It's just kind of an interesting spot we've been kind of sitting in for a while.
Yeah, and there's some. What's funny is the far end of both political spectrums think the country's in the worst place we've ever been, which is funny.
Oh,
Both
yeah.
sides agree. It's the only thing that the far right and the far left agree on, is that they believe the country's in the worst place we've ever been in.
I love to antagonize those folks.
Me
Like,
too.
oh yeah.
They're the best.
So yeah, if somebody's like hardcore one way or the other, I'll be like, oh well, actually, I'm this way, and it should be
Yeah.
that. I'll take the opposite approach. So
I'm a
that's
lifelong
basically,
independent. I vote on both sides. I have very confusing, I'm on both sides of the aisle for a lot. But what I will say is, the good news is that when you look at the fundamentals of the US, we can talk about all kinds of different things that are concerning that are on the horizon. The fundamentals of the United States are so incredibly strong right now in relation to the rest of the world. We find ways to cause problems at home. We have gridlock in Congress. We, have all kinds of division in the left versus right, realigning themselves with labor and business, et cetera. But we're so much stronger than any comparable country or
there.
organization.
Yeah, just the other day I was reading an article in The Economist, and they were talking about growth rates like in the U.S. relative to Europe and the rest of the world. And to your point, yeah, the U.S. has been running, kind of a little bit ahead of everybody else. And structurally, I'm not sure why I would see that necessarily changing anytime soon. And then we got these other like really big macro trends, like people are starting to bring some of their manufacturing back from China because they kind of realized during COVID, the whole supply chain thing, some of these countries, it's like, well, you can't really trust them, and there's some benefits to having your supply chain a little more centralized, right? So prior, up until earlier this year, I was working at for AWS on a SaaS supply chain application, so I nerded into that. So yeah, it seems like we're kind of ahead of the game, and if anything, a lot of the trends are kind of heading in our direction for the most part. So
I mean, think about it. We're energy independent, not just energy independent. We're a massive we could produce so much more if we needed to on the US, right?
mm-hmm.
You just talked about China. China is no longer our biggest trade partner. We work more with Mexico than China. Mexico
Yeah.
surpassed China. And so you start looking at some of these trends in the US and why the US is really the biggest game in town. And you start hearing, well, we're going to lose our reserve currency status. That's one of my
No
favorite
way.
ones.
No.
So,
That's
Jan, you
not.
know this.
Yeah,
I can already
no.
see it in your eyes. BRICS is going to come out with its own currency. You're like, BRICS? You
Well, they
mean
might. I mean, they can, but I mean, nobody's going to trust China or Russia with a reserve currency. That's what
they
it.
don't
I
even
mean,
trust each other?
what it comes down to, I think, for that is like which country does everybody trust the most? And even though we might be less trustworthy than we were 20 years ago or whatever, you're still more trustworthy than everyone else. So as long as that stays true, you'll keep the reserve currency. That doesn't mean you'll have it forever, but for the foreseeable future, I see that as pretty safe.
I mean, just think about this. I love this stat. All of BRICS combined is less GDP than the US.
Mm-hmm.
Right. So and obviously China's the shining star there, but India is on the big rise. India is one of the big, big weight to throw around in BRICS. And Modi's very clear that he wants a very good relationship with the West. Right. So
Mm-hmm.
he's not trying to hit anything head on. And then when you add in NATO and other allies, the reserve currency status, I just don't see it in question. So yeah, I'm a big positive believer in the US. I'm a big believer in the US dollar. I think we have a long road ahead of a lot of positive things. The question is, there still are a lot of question marks in the economy, right? We look at things like the office sector and real estate. We look at things like what the future of work from home holds. We look at a lot of the disruptions that are coming down the pipeline. The number one thing I think investors need to be looking at are the opportunities behind all this. So if we know
Mm-hmm.
that the trend is going to be in the right direction over the next, say, 10, 20, 30 years, the biggest question is how to be on the right side of history, how to be on the right side of trends, the right side of the Fed, right? And what decisions they're making and why. So that's what we lean into quite a bit, is looking at these trends, trying to extrapolate opportunities.
Yeah. So another question I had was on the commercial market, right? So like after COVID, everybody's working from home. It's like, okay, there's going to be this implosion in the commercial market and retail and office space in particular, but doesn't feel like that's happened yet. So is that not going to happen, or is it happening and I haven't noticed, or it's going to happen later, or what's your take on that?
So I'll give you the zoom in and the zoom out. The zoom in on it is retail specifically, it's market to market, right? There's some markets that it's not super strong. There's other markets it's killing it. It's doing great, right? It's a retail boom. In Southern California, so I'm out of Southern California, there are really strong retail trends in our neck of the woods, right? I don't have the long-term perspective on retail as strongly as I feel for other asset classes. Office, on the other hand, I'm pretty concerned. I think that there's a case study for both, and there's trends going both ways where it's a really bad direction and the case that it bounces back in the future. If you look at office today, there's about 20% vacancy right now, right off the top. That's
Mhm.
problematic on its own. There's another 20% of occupied but unutilized, right? So
Right. So
someone
the company's paying rent, but their people aren't in it. Right.
Exactly right.
Yeah.
So it's the rent's being paid, but when that lease comes up, they're not renewing. So that's
Hmm.
effectively a future likely 20% additional vacancy rate. 40% vacancy in any real estate sector is deep problems. So those trends in office, I don't see as resolving and with an easy solution. For me in the commercial space, I'm looking at industrial for really the reasons you mentioned earlier. Think about we're pulling manufacturing away from China and nearshoring or onshoring back to the U.S. We still have trade partners across the world. We're, if anything, diversifying quite a bit or bringing it on where it's very safe. I think Mexico's a huge case study, again, as our biggest trade partner and growing as in a growth economy. So I'm looking at Southern US industrial and warehousing and manufacturing, things that have port drivers. So like East Coast, West Coast, both sides I think are great. Things that are near the Mexican border, I think are great. I think industrial is a huge bright spot for the American economy and opportunity for real estate investing, really 10 to 20 years.
That makes sense. Yeah, the office space one is interesting because I know there's like a lot of companies driving people back to the office. Like, Amazon's famously doing that. They went like 5 days a week now, even when people don't have any coworkers in the same city. They're actually doing it to drive attrition, but they're kind of getting away with it. And some other companies are too, because the economy's not smoking hot. So people aren't super confident. So they're kind of putting up with it. But it feels like if the economy takes off and people feel real confident about jobs, they're going to say, screw you, I'm working from home. And that's going to hurt the office space section. If the economy, like if we hit a recession, if the economy pulls back and jobs are scarce, well, then everybody's going to go into the office like they're told. And that was so I almost feel like office space is going to be like inverse with the rest of the that's my amateur economic theory that I came up with.
So I actually have these numbers. You want me to give you the exact numbers on this? Because
Sure.
we slice and dice this so much. So before COVID, pre-COVID world, right? BC, before COVID, right?
Mhm.
BC, it was 8% of US employees work from home. So 1 out of 12. During COVID, that spiked to over 50%. Huge spike. And we
Mhm.
know the reasons for that. Most people were locked in. Most states had a very strict, strict work from home policies. You can't have open offices, et cetera. In California, we had freaking plexiglass everywhere. I mean, you had these, it was very, very extreme in most markets. Now, we saw that post COVID, in the first year or two post COVID, shrink down to about 1/3, 33% of the workforce was working from home.
Mhm.
Slowly, that's backslid to exactly your point, Dan, is it seemed to stabilize about 25% work from home. And then in the last year, the Amazons, a lot of the big companies, big finance in New York, they're starting to
Mhm.
send people back into the office. Right now, it's ticking back to like sub 20% of the market, of the jobs market, is work from home. But there's an interesting statistic where, especially, I'm in a net export of brain power state, right? So a lot of high earners or mid earners in California left. They went other
Mhm.
places. And what the trade-off is typically is about 30-ish% in income. So a lot of employees are saying, hey, I'm willing to work in a different market and work from home for a discount. So
Mhm.
I don't have the future trends of what that looks like, but right now it looks to be semi-settled. Around 20% of the workforce is work from home. They make a little bit less, but maybe their cost of living is much less, right? So maybe a 20
Mhm.
to 30% discount on their income makes up for the fact that they're saving 40, 50% in their cost of living. Many people are running that math right now and I think making, the right
Well,
decision.
and just all the commute time and friction, especially depending on where you're living. I mean, that's like can be extreme. Yeah.
I'm blessed. We don't have a huge commute time. We're pretty close to the office. I live close, but ouch. Yeah. Commute time. I think people forget that people used to drive an hour each way, hour and a half each way. I mean, those were like, real troopers, real, tough people to put that up every day.
Yeah, I've done that at different points in my career for a while. And yeah, by the time you get to Friday, you're just wrecked. I'm just kind of done
I don't
at
want to
that
see a
point.
car. I don't want to even look at a freeway.
No,
But
not
the
at all.
question is, here's an interesting perspective. We can look through real estate, we can look through notes, my two favorite things, my two favorite investment outcomes or opportunities. The question is the stock market, because that's what we're always benchmarking to. They throw us in that category of like alternatives, right? Even
Hmm.
though, arguably we were around before the stock market, but okay. Let's say we're alternatives. Goldman Sachs just came out this week, within the last week, and said their outlook for the next decade of the S&P 500, arguably the 500 biggest, best companies in the world, or 500 of the best companies, the outlook is 3% annually for the next decade. And that's Goldman Sachs
For stock market growth,
for the
as opposed to
stock
like the
market growth.
traditional 7, 8, 10, whatever. Yeah.
Exactly right. 3%. So now here's another alternative way to look at it. If The Federal Reserve sticks to their federal dot plot, which is what they tell us as consumers, as borrowers, what their game plan is with rates over the next, 12, 24 months. The Federal Reserve is indicating they want to drop rates by 2% over the next 18 to 24 months, if you look at the dot plot.
Mm-hmm.
So let's say they drop rates by 2% over the next couple years. What happens to CDs? What happens to savings accounts? Let's say those drop 2%, just roughly in
Yeah.
tow. So what's your CD at? 3%? You know what I mean? So at some
Mm-hmm.
point, if inflation is at 2 to 2.5%, which is kind of where we're bouncing around right now, you're making less than 1% on your money in the stock market, if Goldman Sachs is right, and on savings and CDs in your bank, if the Fed sticks to what their game plan is. So the real question is right now in the market is, where is the yield over the next decade? Right? To me, alternatives are the shining star there without question. I think you look at the US mortgage market, one of the most stable industries, one of the most stable asset classes in the world, especially single family. Huge opportunity. I very, very much think so. And as well as hard assets. You look at commercial, you already know my thoughts, my rosy
Yeah.
perspective on industrial. But to me, those are the drivers, because just what else are you going to do? You're going to go get 3% in the stock market, a volatile market by nature, right? Not
Yeah.
me. I'm not I don't try to downplay stocks, but when Goldman Sachs throws out a 3% expectation per year for a decade, I'm drilling down quite a bit.
Yeah, for sure. Yeah, that's the thing was that's kind of what drove me into real estate originally was after the dot-com boom and bust and the financial crisis was trying to avoid some of the volatility of stocks. And I always tell people, some of it kind of depends on how old you are. Like when that stuff happened to me, I was younger. So whatever, like you grow out of it, it doesn't matter. But if you're in retirement or you're like nearing retirement or getting up there, that volatility becomes a big deal. Because if you hit one of those big down cycles, it's really hard to recover.
That's why I love
So,
fixed income right now, for exactly that reason. So we're
mhm.
leaning into that a lot. Is I even real estate funds right now. I was laughing today. I just texted my accountant earlier because we invest with people that are quote unquote competition or competitors all the time. Because I'm like, that guy's a great guy. She has a great fund. This person's a good operator. I can't wait to throw money over there, learn what they're doing, see what they're doing, get returns with people that I like. I just
Mhm.
got my first distribution from a fund I invested in, I don't know, 18 months ago, 24 months ago, because they paused distributions. And I'm going, these guys are great operators, but I'm not patient, right? I
Yeah.
want fixed income now. So 3% is not an option for me because there's too much risk for 3% for the stock market for me. Now, when I look at something like, the note space, again, I'm a huge fan of. There's huge opportunity. You can make good returns. You're dealing oftentimes with mortgages that have 10, 20, 30 years ahead of payments. To me, that's a rock solid foundation.
Yeah, for sure. Well, Nick, thanks so much for coming on. It's probably a good stopping point. So how can people get a hold of you if they want to learn more?
We dive into really, really, really great economic topics and strategies for investing in the environment we're in. We give all these away completely for free reports, deep dive webinars that are done live to answer Q&A, etc. People can find all of those at saintinvestment.com/resources.
Awesome. Well, thanks again, Nick. Really appreciate you coming on.
Dan, great catching up with you today. Talk to you soon.
All right.